Welcome to the final Red and the Black webinar for the year. And today we're joined actually to have a discussion about whether next year is going to bring a boom or gloom. In the insolvency practitioners amongst us know which way we'd like it to go, but anyway, we'll hear from the experts today. So we'll take questions at the end. So there's a chat function there. Please put your questions in the chat function. We'll come to them as we get to the end of the presentation. And so we're joined today by Con Vulcius, who is National Partnership Director for Judo Bank. And I might just hand it over to you, Con, to do the introductions and tell us a little bit about Judo. Thank you.
Thanks, Stephen, and thanks for having us on your Red into Black. As Stephen's kindly said, I work in Judo Bank. Judo Bank's a listed APRA bank. We listed in November last year. We're built quite differently to the other banks that you probably know of, the majors and all the rest of them. We've been built around providing solutions for business bank customers, so SME clients. Specifically, we don't do any retail banking per se, so specifically built for businesses and really trying to fill in a space where the majors we think have, let the SME market down. Just to give you a brief background, so when we listed last year, I think our balance sheet was sort of sitting at about $4 billion. I checked about a week ago, our balance sheet now is sitting at 7.1, so almost doubled since listing. We are looking to continue to grow, so we've got offices in every state except the Northern Territory. We've recently expanded into some of the regional areas, so we've got offices in Geelong. I'm currently in Canberra, so we've got an office in Canberra that's been opened about 18 months. Also offices in Sunshine and Gold Coast, Toowoomba, basically all the major regional centres, and looking to continue to grow into those spaces. So as I said, built for business, we're really looking to back SMEs and to do banking the way it was, banking the way it should be, and helping customers grow. We're very fortunate today to have Warren Hogan with us. Warren is the Chief Economic Advisor to Judo Bank, and has previously spent his career with the New South Wales Treasury Corp, Westpac, Credit Suisse, and the ANZ Bank, where he was Chief Economist from 2009 to 2016. Warren and I have done quite a few of these sessions, and they're always very interesting. Warren's also a regular contributor on the AFR and also on Sky News. And the best part about Warren is he speaks in normal speak and not in economist speak, and also isn't afraid to give his opinion when needed. So, Warren, I'm going to hand over to you now. Look forward to hearing from you, mate.
Great. Thanks, Con. Thanks, Stephen. It's great to be here. We've got a lot of ground to cover, so I'm going to get started. The idea here is to give you some access to the big macro forces at work, think about them. None of us know the future, and we're at a critical stage. It's all about interest rates, not just here, all around the world, which means it's all about inflation. And so I just hope to give you some more insight into how to think about it. And as a state of play, entering the final month of 2022, a bit of colour on how I see it all playing out. So I'm going to share my screen, get stuck into it. Hope the technology works. There we go. Fighting inflation. I don't think there can be any doubt about what's going on here. The governor of the RBA spoke last night in Melbourne, and central banks all around the world in the last 6 weeks have made it abundantly clear there is no trade-off between inflation and anything in the long run. It has to be addressed. It has to be contained, and it will come at a cost. And the quicker and the more effectively we do it, the minimise that cost. If we let inflation get in the system for any period of time, which I'll talk to about the context around Australia, the costs of removing it are astronomical, as we saw in the United States in the early 80s and Australia in the early 90s. All right, I'm going to quickly go through some international themes just to give a bit of colour around what's going on. That's the long view of UK inflation back to 1860. I'm showing this for two reasons. One, this is a genuine inflation challenge. Fourth in that 160-year period, you can see there. Two, inflation is either low and stable or it's not. All of these inflation shocks start with an unexpected shock, and they're transitory. They will go unless you let the inflation get stuck in the system, and that's what happened in the 1970s. And that was what was so costly an inflation to rid ourselves of. And that's just all about what I'd call the second phase inflation, which is domestic inflation expectations of wages. These modern economies, whether in Europe, US, Australia, are more than 80% services based. The biggest underlying cost is labour. And if labour costs are stuck at a rising level, you can't get rid of the inflation. So that's the big theme. It's about moving on from the pandemic shock that is actually going, and I'll show you some evidence of that, and addressing the domestic inflation risks in all of these economies at differing degrees. Okay, just to confirm that the initial pandemic shock, which was a shock from essentially a surge in demand for stuff. When we locked these economies down, provided income support, we couldn't spend on services, we spent money on durable goods. The global manufacturing complex and transport and logistics systems could not handle that surge in demand. That put upward pressure on prices everywhere. That was the shock. It's going now. You can see here a great indicator from the New York Federal Reserve Global Supply Chain Pressure Index. There, it's mapped against US core inflation. I'd like to think that you're going to get the outcome implied by that, but the next phase is actually more complicated than just the easing of the global inflation challenge, the pandemic shock. It's now about this domestic side, but we are seeing the global shock go, and you can see oil prices have also come off. Commodity prices across the board, with the exception of sort of some parts of the energy complex, are now well off their highs. So that initial shock is going. You're seeing that in the US. You see markets universally celebrate. A few weeks ago in the US, CPI annual rate dipped below 8 for the first time since February. Confirmation of a peak was put in back in June of 9.1. Reality is, though, is that peak and that rolling over of US inflation, welcome news. But it was largely driven by energy, stronger US dollar. The fact is it's an early victory in this war on inflation. Many victories lie ahead for a successful and ultimately victorious campaign against inflation. And the reason is, you can see here is in the US, wages, which is measured here by their employment cost index, and core inflation. This measure is their core PCE deflator, which is the Fed's preferred measure. It's just another measure of inflation. But you can see the problem is that their labour market is tight, unemployment is low, labour shortages, wages are moving. They've got a much more flexible labour market than us, and hence prices, i.e. wages, are moving already. And when you've got the biggest cost in the economy, i.e. labour, running at 5%, you ain't getting inflation down to the target of 2%. So the Fed is now going all in. They hiked 75 points. The Fed funds rate's at 4, highest since prior to the GFC. And you can see on the right the services inflation, which is essentially, again, that domestic inflation, no signs of, even a peak, let alone it rolling over. So the inflation battle is far from won, despite the celebrations of markets. As I said, an early victory in an early battle won with it rolling over, but the war's got a long way to go. Okay, so in another concept I think we just to bring in here is, as the great Warren Buffett, his best saying, the best saying in economics and finance, when the tide goes out, you find out who's been swimming naked. And that's the key here. The tide's going out, policy's tightening up, rates are going up, liquidity's drying up, QT, all of these things are putting pressure on financial structures. Now, obviously, crypto is the big bubble. There's no doubt about that now after FTX. It had all the hallmarks. It had obviously huge price movements, speculation, supported by cheap money. And now we know there's the swindle, as Kindleberger put it, the criminal element. And that's all playing out. I don't know when it's going to fall or where it's going to fall to. I'd suspect it's further. But of course, like many bubbles, there's actually something real going on. So don't totally discount it. There's a lot of important technology in that space. It just is going through its very early growing pains. But we can see Australians coming into leveraged tech investments. The Nasdaq's been hit hard, although performing better lately. What we're not seeing, though, is this tightening up really getting into the core financial system. Equity volatility is up, but it's up in a very orderly fashion. No spikes like we saw in the start of the pandemic, or if you go back to the GFC or go back to the tech wreck. And we're miles away from core banking systems coming under pressure. Now, that's remains to be seen, but this is an important concept in tightening of policy is you're tightening things up, you're making money more expensive, there's less liquidity, and there's certain financial structures which won't make it through. The next port of call will be high risk credit markets. And then of course, the big one, which we want to avoid, is getting into the banking system. That's what happened in the GFC with US and Europe. That's what happened in Australia in the early 90s. I actually think the banks are so well regulated, we're not going to see it. But anyway, that's the end game for a financial crisis. I don't think we're going there. Okay, in terms of where the global economy is going, this is an important concept. So this is US durable goods spending, dollar value every month, going back to 2013. You can see with the demand shock, what drove the inflation. But importantly, where to next? This is flatlining. It's a big reason that the US is struggling to get growth in the economy. We had flat growth, a technical recession, if you will, in the first 6 months of 2022. It's because after spending so much, there has to be a retreat. There's only so many lawnmowers you can have in your garage. The big question is, how far does it retreat? How quickly? I don't know the answer to that. This is very much about what's going on in the world, about how long people keep things for, how much income they've got. But you can see clearly one concept about this downturn: it's not a financial crisis. I really am not attracted to that view. I could be proven wrong next year. I hope I'm not, but it will be a long, drawn out slowdown. So not a deep recession, a long one. And that might be the best outcome for the whole world. But it also is important because the way that ricochets around the world is different to a financial crisis. You get a crisis like the GFC or the start of the pandemic, everyone gets hit. But this sort of thing, it's more domestic based. The trading patterns are more important. And I'll come back to the implications of this for China in just a second. Sorry, my mouse is very sensitive. So this is world trade. It is slowing. There's no doubt about it. It's dominated by goods. The annual figures here for trade and industrial production are still holding up. They will slow further. Canary in the coal mine, South Korean exports, latest figures showed another big drop. Bit of a US dollar effect in that, but quite clearly the real exporters, from everything from electronics and technology through to the end of the start of the supply chain like us was commodities. I think you're going to start to see that rolling over. This is gradual. This is not something that's going to create massive crisis points in these economies. It will be part of a necessary and inevitable global slowdown, but an orderly one. Okay, I just want to finish off with China. I'm very concerned about China. These charts show global exports from 2016 indexed. You can see the movements. Basically, the big beneficiary, one of the biggest beneficiaries of the lift in demand for stuff, for goods, is obviously China. Other advanced economies, not so much. China outstripped global trade through this period. And then on the other side, imports, very much the US drove it. Yes, Japan, a big consumer market, modest growth, good growth by Japanese standards. Euro area, the same big consumer market, but no, it was the US. And of course, China has a property bubble that they're gradually trying to unwind, which is proving to be a major headwind. COVID lockdowns, I think, are a ruse for that. But the reality is this highly favorable global trade situation is about to disappear for China. And that will have big implications. So they've got a lot of challenges now. Yes, some people in the market think that we're near the bottom and that their government will be able to recharge their economy. Look, I'm not calling a major problem in China, but we're past peak China in terms of being the marginal player in the world. They're going to have much lower growth going forward. And I still think there are genuine economic risks. And I think that has major implications for the politics, already has, because they just don't have that growth story that they once did. And that was so important to their political legitimacy domestically in many ways. Okay, so that global picture, to give you a backdrop, is all about the inflation story, all about slowdown in growth, and it's all playing out. You'll hear lots of stories at various times about how it's going to be sudden and severe, and there'll be other stories about the economy being resilient. I think at this stage, the best way to think about it is a slowdown and recessions, but not deep recessions, not crisis points as such. All right, in that context, where we are in Australia, well, the first thing we need to come clean with in this country, and I think we have now, is that our inflation challenge is every bit as daunting as anywhere else in the world. With our September quarter CPI, we have core inflation here measured as trim mean up as high as anyone, really. You can see that in there versus the US. I mean, they're all different measures, but the idea is that our underlying inflation pulse is around 5 to 6, just like America, just like the UK, just like Spain, Canada, probably New Zealand, who hiked 75 basis points today. I might add to an RBNZ cash rate of 4.25%. And they're now, 1.35% above Australia. And we've got the same problems. There's no point denying that. In fact, there's a few things that worry me that we've got even bigger challenges. One is our energy shock is happening now, and the worst is probably ahead of us because our retailers and our wholesalers absorbed that for a little while, whereas in many other markets, we're actually past the worst of that in many ways. And you saw a big fall in German PPI because of a big decline in energy prices. So we are right there staring down this inflation challenge like anywhere else. You can see here, the RBA has responded. We all know this. Their mortgage rates. I'll touch on res property if we have time, which I'm sure we will. But it's been a big change, somewhat embarrassing for the RBA. They never should have done that forward guidance, but I will stop talking about that when we get to 2023. But they've done the right thing, both in aggressively lifting rates and more recently in pivoting back to 25s. And the difference here, where probably the UK is the only similar market, is that we have a lot of variable rate lending, both in business and more importantly in the mortgage space. And that means they get more bang for their buck. Now, we don't know what exactly that bang looks like. It's different every cycle, but they do get more bang for their buck than the US, where 90% of mortgages are fixed. In Canada, where 85% are, New Zealand, 80%, et cetera, et cetera. So it doesn't change the end game. Australia's interest rate will still have to get to a certain level. It's just that the pathway there, they have to be a little bit careful that they don't put too much pressure on the economy. And I think the politics of it for them is, after telling everyone they weren't doing anything with rates, they need to be careful of suddenly jacking them up too much. They just need to, bit of caution. But I think they've done that now with the pivot, and now they've really just got to do what they've got to do, because we've got an inflation challenge here. Now, the expectation is that inflation will peak this current quarter we're in. We'll get one more result at the end of January. The government's at 8, RBA is at 8, or government's at 7.75. I mean, I don't know. I mean, I'm not sure that whether it's at 7 or 8 is the big deal. It's the fact is it's got to come down. Now, that's the view that you can see there, that it comes down pretty quickly by 2024, back to target. And a lot of things have got to go right for that to happen. And this is, I think, just to state it quite clearly, the real monetary policy challenge. They don't want to hike one more time more than they have to. But if they don't do what they have to in a timely fashion, they get behind the game, and they'll ultimately end up having to take the cash rate higher. And if they really get behind the game, a la 1980s, or you can even argue 2007, they may have to take the cash rate to such a height that they have the end results of recession. So it is a judgment call, and the RBA from here on in, they are earning their money big time. This is the greatest challenge Phil Lowe will have in his career, I believe. It's much harder to get this sort of tightening calibration right than doing all the stimulus they did in the pandemic. And no one knows what's got to be done. And I think at this stage of the game, there's more to be done. And I think they recognise that. His speech last night, I think, recognised that. So you got to get this balance right, doing enough early to make sure you don't have to do too much later, basically. Anyway, our inflation, domestic inflation is rising. Wages came out. I'll show you some wages data. They're moving. I mean, the fact is that any economist should have been saying this all year. I mean, I was. It's a lagging indicator. We've got regulated markets. And even if the labour market stopped in its tracks today, the wage story would still play out for another 6 to 9 months. So you don't want to get behind the game on wages, because that means you're behind the game on inflation. So here's the wage story. Sorry, I'm just trying to move my, and of course it moved to. Okay, so this was the wage price index from last week for Q3. It comes out a bit late. What I've got you there is the private sector 6-month annualized rate, just to give a sense of the pulse. And I think it's pretty clear what's going on, and that the inflation pulse has gone right back to where it was pre-GFC in terms of the private sector. Essentially, the regulated parts of the labour market are slow to adjust, whether it's long 3-year EBAs or other reasons. You know, the unregulated, less regulated places of the parts of the labour market where people can negotiate in a more timely fashion, they're moving, and we all know that. And the whole thing's moving. We've got the government cheerleading it, thinking that the story in Australia is a low wage problem. It's not, it's a low real wage problem. And catching up with nominal wages is not going to work. It'll just make the problem worse. The only way to get real wages up in the next few years is to get the cost of living down, i.e. get inflation down. Anyway, you can see by state an interesting divergence where the big states, Queensland, Victoria, New South Wales, the wages aren't going up as much as the smaller states. And the overlay to that is that the eastern seaboard big states, they're actually doing best in terms of activity in the last 4 months. So I think that shows you how much the shortage story, the full employment story is at play here, because in the bigger states, you've got bigger markets, you've got more places to tap into. Smaller states, less wiggle room, I think, is the story there. So I think this is very much about full employment, excess demand, labour shortages. It's classic. You know, you take the unemployment rate through its full employment level and you will get a price response, because you essentially we have 475,000 unemployed according to the labour force survey. And then we've got 475,000 job vacancies. And there's a big mismatch between them. You're not going to match that up easily. It's skills, it's geography. And of course, what you're seeing is any new demand for labour is having an impact on price, wages. There's your unemployment rate. It's at a 48-year low. Not sure how much further it can go down. Then the main game, the whole thing is about these job vacancies. It's a great indicator of this imbalance, excess demand for labour in our community. I've been speaking to businesses all across Australia, well, for a long time, but in the last 6 months, 12 months, it's ubiquitous. No matter where you are, what industry, what skill level you're looking for, there are shortages, and that has to go. And that job vacancy number has to come down. Now we're going to get some improvements in this labour supply with the borders open, and we're now starting to see temporary visa holders come back, students, some of the backpackers, obviously the permanent visa holders are coming through and have been all year, but they add demand to the economy. They don't, it's not a magic bullet. It does, you know, some harm as well as good in terms of this story. The reality is that a big important source of rebalancing labour supply and demand is going to be business failure. And the freed up labour supply that comes when businesses fail. And the longer that whether it's because of the micro of the ATO or what have you, not doing enforcements, or whether it's rates are too low, the longer we don't sort of go through the necessary and normal processes in a market economy of cleaning out businesses that don't have a long-term future, the more it's going to make this story even harder. And I think that's an important element of this story that doesn't get talked about. Okay, in terms of the inflationary attitudes, look, consumer sentiment's in the recession levels, and it is all around the world and has been for a while. Business confidence, on the other hand, is holding up. It's actually dipped to zero. There's other measures which are a bit lower, but it's holding up. And that's, I think, a really important indicator that businesses are able to pass on these input costs. It's been the supply chain costs. It's been the materials costs. It's becoming the energy costs, and it's becoming the wage costs. And I don't think there should be any illusions that if these wage pressures and the energy costs go up in 2023, businesses are going to pass it on. It's happening. And consumers don't like it, but they've got jobs, they're getting wage increases, and by and large, so far, the evidence suggests they're paying for it. So it's an inflationary environment. not as bad as the 70s, but we're at the early stages of that inflationary environment. Look, this is the scary story. I won't dwell on it. Basically, we've got here real economic growth going back to 1992 versus the real short-term interest rate, which is basically what the RBA cash rate minus inflation. This is what economists look at. I'd argue that in a stable economy, they broadly match up. They haven't matched up for a while. They certainly don't match up now. The consensus is with a 3.5, 375 cash rate by next year and inflation coming down, we get a positive real rate, and that should get the job done on inflation. Well, the scary story is that no, you've got to take it up to the rate of growth of the economy, or you got to go higher. And then we're talking, unfortunately, 4.5, 5.5, 6 cash rates. Now, no one's contemplating that with any seriousness. I have a top of the market call for it, the cash rate getting to 4.5. And that's a big part of the analytic. The world of the last 10 years may not be the relevant reference point. It may be the world of, well, a lot longer than that, where that fundamental holds place. But that's the upside risk to rates. And I think, unfortunately, the downside risk to the economy on a 2 to 3 year view. Money supply, US and Australia, obviously, we've rewritten the rules. Well, hopefully we have on money supply. You can see there, that's going back to 1960. They're doing QT, they're reducing those balance sheets and that'll come down, but how much inflation is that now putting into the system? I don't know, Ben. These are the scary stories. I don't think we should dwell on them, but for every time someone says you got to stop raising rates, it's destroying the economy, it's doing this, well, there's going to be huge amounts of calls for that because they're putting pressure on financial structures. They're putting pressure on asset prices. But on the flip side of that voice that's going to be coming out of the economy to try and work against the RBA hiking, let's have a look at some of these big pictures on what inflation potentially could be doing and get a balanced view of it all. It's a tough job for the RBA. I do not envy them. Phil Lowe is really going to have his hands full, and I think he's the right man for the job. And his deputy, Michelle Bullock, is the right woman for the job too. They've both got huge amounts of experience and they're tough. Okay, so here's some scenarios. This is the cash rate to now. I've got to go to 4.5, 4. Let's hope it. We don't want to go any higher than it has to. The optimistic view is that they sort of stop soon, which a few economists have that view. I'd love to think it's the right view. I don't think it's the right view. And then there's the worst view, which is that they've got to really get on with it. We'll learn a lot more in the next 6 months. I can tell you that much. Anyway, whatever happens, rates aren't going back to where they were. We've got a whole lot of stuff. The governor's speech that he gave last night, I'd highly recommend anyone interested in this stuff, read it, print it off, read it. It's the fundamentals of our economic environment. And basically one of the stories that I've been looking at for quite some time now is that the disinflationary, low inflationary world that we've had for 30 years is behind us, and the demographic shifts, technology shifts, deglobalization, climate change, a lot of it's pointing to not so much higher growth, unfortunately, but higher inflation. And that means higher rates. So I think you're planning, you got to be thinking that, I hear people say, well, they're going to raise rates and they're going to cut them. I don't think we want to go back to a world of zero interest rates. It is not healthy. It will not be associated with a very healthy economy, creating wealth and raising living standards. An economy of an interest rate of 3 to 5% is a much better economy, and I think that's where we're going. I'm very positive on Australia on a 5 to 10 year view. For all the reasons that we've got to this point in time, there's no reason to think we can't continue to succeed well into the future. Okay, so the view on the economy, this is GDP in dollar terms, in the forecasts. I call it a rough landing, soft landing. I mean, we're trying to pull off an amazing trick. We're trying to get rid of serious inflation without a major recession. And I think we get away with this, it'll be, again, the lucky country. I don't think the US is going to get away with it. I don't think Europe's got no growth anyway. Japan's got no growth. Anyway, let's see. But this is the central case. You can see here the potential, that's the capacity. We're running through it. It's clear. We're probably going to run through it for a little bit longer, but we've got to go back under it, free up some space out there. I mean, it's a better world. I mean, I think we're learning that it's no fun working in it, not fun, but it's difficult operating an economy constantly through capacity. I've heard all these things you can't get done. I mean, the crazy one I heard last week was a mate of mine can't go on holidays because he can't get his dog into a kennel because they're all full. I mean, it's a pretty trivial thing, I know, but it's just symbolic of this sort of idea that running an economy at absolutely maximum red line capacity is not necessarily a great way to live, whether you're in business or an individual. So we need to free that up. It looks like that on the right on GDP growth terms, a very mild downturn, really. I suspect it's going to be deeper and a little longer, not a major recession, but a rough landing. So that's, I think, a little bit optimistic. But we've got slower growth coming. There's no two ways about it. Okay. I was asked to talk about the Australian dollar. I've been trying to avoid that topic for a long time because I have no idea what's going on. Neither does anyone else. So let me explain. The Australian dollar is soft. You can see in terms of the US dollar, we hit very low levels. So we're still sort of there, basically. It's bounced a fair bit in the last couple of weeks, but you know, it's soft. But that's a big part of it is because the US dollar is strong. You can see the US dollar trade weighted index going back to 1980. It's not quite Plaza Accord times, mid 80s, but we're going like the tech bubble. And you look at that picture and you think, well, this could go a lot further, but you can see our trade weighted index has basically been moving sideways for the last couple of years. It's not at a high level by any stretch, but it's not, the US dollar exchange rate's a little bit misleading. Anyway, that's the history. What's the fundamentals? Well, there was a time when commodity prices told you everything you needed to know about the Aussie US exchange rate. So I've split it into the last 15 years of last century and then this century because there's a break. I like to keep things as obvious as possible. So this is RBA US dollar commodity price index in blue versus the the trade weighted index for the Aussie dollar. And you can see the commodity price cycle was everything. And you can see when we went to parity on the US dollar, we got a trade weighted index up around high 70s back in 2010. And then you can see what's happening now. You can see a huge increase in commodity prices in the last 18 months. And the Aussie dollar has not responded. Now, the governor talked about this last night, which is great. And he confirmed his opinion is one I've been talking about. And that is that this commodity price boom is a price boom only. There's been no follow through with investment. And that investment historically typically is a lot of global capital coming to Australia to build large mines and infrastructure around that. And we're not seeing that. So the Aussie dollar hasn't gone up as much. So that's part of the explanation. Doesn't help us with where it's going to. I mean, commodity prices could fall a long way and that would have no implications for the Aussie dollar, but I find that hard to believe. It's very tricky to calibrate where the Aussie dollar is at. So what's another metric we use? The interest rate differential. Here it is, the TWI is that, don't even know what that color is. I think it's yellowy, browny mustard. And then the 2-year interest rate differential. So it's trying to capture not just monetary policy differences, but also sort of 2-year interest rates, 2-year bond yields. And you can see that with the Fed getting aggressive, it's now back to minus 1.15, or a bit under that. And that's as low as it's been. And typically when it's been this low, not so much in this episode, but back in the mid 90s, the Aussie dollar was a lot lower. So the interest rate differential, I don't think is overly compelling, but it certainly is consistent with that idea that the Aussie is lower than it otherwise would be. And then the fundamentals of all fundamentals, the real effective exchange rate, PPP, the Big Mac index from the Economist magazine, whatever you want to call it. This is going back to 1970, big long wave cycles there. And if anything, this is telling us that if that cycle is the right, then we're only halfway through a downward adjustment. So look, I can't offer you much on this, other than I wouldn't be fighting the trend. They seem to be both a short-term and long-term trend, that is for a stronger US dollar and a weaker Aussie. And of course, that's not making the RBA's life any easier. And I'll show you why. Basically, we've got a massive income shock coming out of the world economy. The world economy of 2022 is not great for most economies, whether it's uncertainty, the war in the Ukraine, the high price of commodities. But for Australia, there's some big positives offsetting the other uncertainties, and that's the price of our exports. So mining profits in the June quarter exceeded non-mining profits for the first time ever. This is those two expressed as growth. And you can see something, I only found this out a few months ago. I don't know what I was doing for the previous 25 years of my career, but Basically, mining profits lead non-mining profits by a year. Makes complete sense. Whitehaven Coal makes a fortune. They pay dividends, they pay taxes. It gets into the economy. This is a genuine income, positive income shock. This isn't funny money. This isn't QT. This isn't QE, I should say. This is Australian domiciled entities getting massive income boosts from overseas people and corporations. And you can see it's happening in the farm sector as well, despite the current flood crisis. Some good crops and good output from farms combined with incredible prices have resulted in a strong agricultural community. And I've seen that up close in the last few months in various states around Australia. So this is making the RBA's job harder. It certainly doesn't argue for an economy that's teetering on the brink of collapse after 275 basis points of rate hikes. There's vulnerabilities in our housing market. You know, there's people who are doing their dough in crypto for sure, but they have got to set monetary policy for the whole economy. And this is a big positive shock. Sure, Jim Chalmers didn't recycle all the extra money he got in the last 6 months, $57 billion, not all from commodities. He didn't recycle it all back into the economy like many governments in Australia have in the past, most notably Howard and Costello prior to the GFC. But still, that money is in the economy in many other respects, dividends and so forth. Construction side, and then I'll get into res. I think we've got time. So the big move in the pandemic, and I'll touch on this in a minute, lots of shifts in housing preferences had profound implications for property, residential property. But there was a big boom in approvals for houses because people wanted to live in houses. That was one of the big ones. And the downturn in the apartment boom, construction boom of the middle of the last decade, sort of any recovery was truncated. What we're seeing now, though, is house approvals in the last 4 months. This is data till September, I believe. September 22 seem to be stabilizing at pretty solid levels. And then the apartment side, early days, could actually be picking up. They could easily turn down, though they're very volatile. But the reality here is that combined with constraints that have meant there's quite a big pipeline of res construction around the country anyway, this doesn't tell you that market's about to collapse. And if you look on the right, this is all that volume, numbers, but you look at the value of building approvals, they've hardly fallen at all in totality from their peaks, and that's because of the cost of building up 20%. So the amount of money we're spending on res is still up there, even if the amount of houses and units and everything we're building isn't as much. So this doesn't tell me the economy is about to collapse. It says to me the RBA's still got work to do. There's lags in monetary policy, I know, but this is a critical leading indicator, and construction is a critical cyclical part of the Australian industrial landscape. Housing. So obviously the pandemic had a massive impact, and this is house prices. So the first thing I'd note is interest rates are absolutely critical to residential property price volatility. And you can see that with the exception of WA and Northern Territory, everyone responded to low rates. You know, obviously you got to have the employment backdrop, the income backdrop, but the marginal driver of these big increases in property values in the pandemic was low rates and readily available credit, of course. That's turned. That's been the big shift. Rates are going up. Prices are down, led by Sydney housing, down 11%. I think the markets that are defying the interest rate increases are WA, Northern Territory, because they underperformed. They still seem to be affected by the hangover from the mining boom of a decade ago. And South Australia is defying gravity, or interest rates, I should say. I'm not sure how long that'll last, but the massive boom in Tasmania, Canberra, and Brisbane houses is correcting as of September, October. So these are just some of the characteristics. So I've obviously talked about the interest rate cycle is all important. The other thing that happened in the pandemic was a desire to move to the regions, especially New South Wales, Victoria, within a few hours of the city. They had a big boom. And interestingly, they're not correcting as much as yet as the cities. So they're sort of defying it. I'm very worried about the regional areas. And then the houses and apartments split. Apartments didn't go up as much, partly because people didn't want to live in them. They wanted home offices, partly because that sector got hit by the closed borders and the lack of tourism and temporary visa holders and so forth. And conversely to the regional dynamic, they are correcting in Sydney and Melbourne in particular. So they're getting somewhere close to some value because there's not much value in Australian property, residential property at the moment. So let me just show you how I think about that. I've been doing a lot of research on this, and we'll be launching actually a product on this very shortly that basically looks to monitor residential property prices and valuations from the top to the bottom. And this is the national market and index with the income anchor. So I create a house price that reflects income fundamentals, and that's useful. It creates a valuation from a macro point of view. As you can see, Australian house prices as a general proposition have been expensive for a decade. I'm sure we can just look back at the popular culture newspapers and the discussion at barbecues to confirm that. And they're about 30% overvalued now. So that's the first thing, the overvaluation. But really what drives it? And of course, it's interest rates. So the overvaluation is that bar. The green line is the real interest rate. So it's essentially the short-term interest rate minus inflation. That's what economists use. And you can see when you turn the interest rate upside down, the blue line here is that bar chart there, the deviation. And you can see the correlation's negative 80%. Obviously, they're inversely related. Higher rates means lower house prices and vice versa. And of course, the implication of what the RBA is doing is quite clear. They're going to have to take that real interest rate up to reduce this inflation risk. And of course, that's going to reduce the overvaluation. So that doesn't mean house prices collapse. There's incomes are going up, and I'm positive on that. As I said, wages growth is coming through, but it's there is an adjustment going on, and it's going to continue into next year. So I think we just need to be careful. Now, different markets represent different risks. The national market is the projection for income anchor, the house price associated with household income growth, and I've got 4% as the average there. That's the consensus, the RBA cash rate going to about 3.5, 3.75, and the inflation rate coming down, i.e. that real interest rate going up to just over zero. And of course, then you get the correction of about 15, 20% in national house prices. They stay expensive. There's scenarios there, but I think it's quite clear that this sudden shift in the inflation and interest rate environment coming from such a low level of interest rates is going to create some real challenges for residential property, and it will for other property markets. I haven't done the work on commercial, and there's different sectors there, but they also will be under pressure, maybe not to the same extent. So there are some other factors people talk about: supply and demand, construction costs. Excuse me. These are relevant, but they operate at the margin to that interest rate story. So look, the reality is that with the big collapse in population growth because of the closed borders in Australia, you'd think we have an oversupply of housing, but nothing in the market is telling us that. Vacancy rates are low, rents are going up. And of course, up until rates started going up, interest rates started going up, prices were going up. So no signs of an oversupply. So I think the supply and demand story is not all that powerful at the moment. It might be in certain markets, but not in the national level. And the construction cost story is real. It'll definitely increase demand for established houses at the expense of renovations and building because of the increased cost and the disruptions to the supply chain and trying to get things done. So we have to watch this, but it'll probably reverse. Prices are coming off from many materials. I think it'll be transitory. I think it is dwarfed by the interest rate story. And bearing in mind that interest rate story is going to be sitting there next year, and the economy will start to slow and the employment story will deteriorate. So there's going to be added headwinds next year. So I just show you New South Wales. I won't go into detail because we haven't got much time and we want to save time, but that's Sydney, houses and apartments. You can see Sydney's already correcting, long way to go. Apartments have corrected, not far to go before they're actually the cheapest income that they've been for a decade. So, you know, this is a thing. The overall market's expensive, but there's certain markets that are really expensive and other ones that are less expensive. And that's part of what this work I'm doing is trying to highlight to participants in the market. I'll leave the projections. They're just based on those interest rate stories. Victoria, I think, is interesting. It's had a very similar story to New South Wales and Sydney. But the big difference, the big fundamental difference is the loss of population interstate through the pandemic. Queensland was the main beneficiary. So I'll just show you Melbourne. Melbourne's very similar to Sydney, both apartments and houses. But then this is the one I wanted to show is regional Victoria, very similar to regional New South Wales. Very much capital stable or capital low volatility, income driven markets. And in the pandemic, boom. And that's simply because city incomes came to the country. And it was the hybrid work from home, all that stuff. And the big question is, what next? Are we going to continue to see that flow? Is it going to stabilize? Is it going to reverse? I don't know the answer to that, but these markets are 40% expensive. They need to be handled with care. So just to wrap up, you can see there 40% for both apartments, exactly the same in New South Wales. Queensland, much less. Queensland's only 15%, very different dynamic there. So yeah, there's lots of different stories. All right, I've got the budget. I'm just going to quickly make one comment. They're not doing anything to help the RBA. They're not doing anything to hurt it, maybe. The states are. The state governments are all spending. They're not helping the RBA. The feds just are sitting on the sidelines. That's fine. I mean, the big issue is all these extra spending programs that we heard about and they gave us. I mean, they're phenomenal sums. And it's this story on the right. It's a record high level of government spending, federal government spending as a proportion of the economy, and the structural budget deficit. Now, do we fix that deficit? And I think it's inevitable. The governor said last night, we need to get this back to balance. And how do we do it? Do we raise taxes? Do we cut spending? That's the conversation they want to have. Given the cost of money's gone up, I think we need to have it quickly. I think the real risk for the government is they don't get that conversation happening quickly enough. I don't think they can wait for a big decision at the next election. I think next budget, they've got to start making moves, is my personal opinion. And I think it has to be a combination of both. I just think those spending levels are ridiculous. We've got to look for some savings there. So I think raising taxes to cover all that's misguided. Thank you. I'm going to stop the share. Hopefully Con is still around and well, Stephen can facilitate questions. I think I did it in my time.
Yes, no, thanks, Warren. As always, you say it as it is, which is great. I've got a couple of questions. So anyone else has got questions, use the chat function and we'll come to them shortly. I suppose my question at the moment is, I was watching something last night and one of the big energy companies came out and said, they were talking about this massive increase in energy prices coming through, I think, next year. And they were talking about figures of 50% and or more. What does that do to inflation? That's that's a major cost for a lot of households. What do you see from that perspective?
Yeah, energy is like labour costs. It just gets into everything. It's like pouring water through it. So it's not so much the fact that, in the CPI, they're going to pick up the fact that we're all going to pay more for our electricity at home. It's the fact that businesses are all paying more, and all businesses, and as we know, they'll pass it on. So it's not the 0.5% direct impact on inflation from household energy costs. It's the 1% or 2% impact from the fact that everything else goes up, and we don't know what that number is. The RBA has given an estimate of a 1% impact on all those second round effects. That seems to be very generous or very optimistic, especially when you're talking about those numbers you just were. We don't know is the answer, but as I said, what we do know is that the worst of it's ahead of us because of the structure of our energy markets. One of the pieces of data last week, which gave me a chill, was the UK inflation numbers. They went from 10.1 to 11.1. Not great. New high. It's not great. If the Truss government's one remaining policy that stays in place hadn't have been there, that is the household energy supplement, if that hadn't have been put in place, inflation would have been 14%. So, we're not in that dire situation from a supply or a price point of view as Europe, but it's going to complicate this. It is. Now there are those that say that this is a tax and that it's going to hurt and that it's going to stop spending, and there's some truth to that. But is it the thing we're going to learn, which haven't had a lot of learnings of, is what's the saying? Economies don't die of natural causes. Nor do businesses. People do everything they can to keep going, and so in this environment, I'm not thinking the tax impact of the higher energy is going to outweigh the inflation impact. But yeah, it's a complicating factor, and it just is. It's going to be tough. It's not good, and we don't even know either what the government's going to do, and I think they will do something.
Yeah, well, there's a lot of pressure on them to actually take some steps to try and keep it under control.
Yeah, well, the so-called manufacturing renaissance is definitely going to be put at jeopardy by this. There's no two ways about that. I don't know. I mean, yeah, it's not clear what the government's disposition is. I mean, I know there'd be some knee-jerk there just to throw money at it, but they're being told by the Treasury that's inflationary. Can we pause on being too ambitious on the transition? It just, there's so much going on. It's confusing for them as much for us.
Yes, indeed. And so one of the things that you mentioned was that you thought that rates might go to 4.5 potentially. I mean, if that, and I looked at all those graphs, and I try and keep things pretty simple. But if they go, and 4.5, if that's the top rate, then presumably what that means is that inflation then starts to come well and truly under control at that level. But we know that, I mean, you mentioned about New Zealand, and I mean, I look at us here, and I think, well, are we that different to other countries around the world? And are we just, are we a little bit behind the 8 ball in terms of what is going on here? And bear in mind that there's only one more, there's the December meeting of the RBA, and then there's nothing until February. What does that mean in terms of where the RBA might go in December?
Yeah, it's the big question I've been thinking about. And the RBNZ went 75 today because they don't meet till February. And they had done 50s, and as I said, they went to 425, so it's not like they're dawdling anyway. The thing that people aren't talking about is that the Fed's got 2 meetings, and so just after Australia Day, the Fed funds rate will be at least at 5%. And so, unfortunately, this is going to be a real test of the board. I think what they've done so far is pretty good. The last 6 months, they've had a shocker before that. I think they should go 50, 25 for January, 25 for December. He said they can do 50s last night. I think they need to. There's just asymmetric risks. It's just a shame some of our big banks have been so weak on their forecast for interest rates, and they've got a terrible conflict of interest, and I think there should be an investigation personally, but it does influence, and that makes it life harder for the RBA. They should be mature, these banks and these economists, and be helping the RBA. To think that this economy is about to crumble is a ridiculous proposition, and the real problem is not doing what needs to be done quickly and leaving ourselves open to a big problem down the track. So look, I think they need to go 50. I think it'll be a very, very tough decision. I think the market was toying after those US inflation numbers. The market was toying with a pause from the RBA. So, this is the thing. The easy part of this cycle is over for everyone, for the RBA, for the forecasters. It's hard now. And in the end, it's up to those 10 board people, whoever they are, or however many they are. I think they should go 50. I think it's a 50-50 chance they'll go 50. They'll go at least 25, I'd say. And I think if they go 25, there's a good chance they're going to have to go 50 in February. So, Happy New Year.
Yeah, indeed. Chris had a question. This is a good question. What would you expect superannuation returns to do in the next 12 months?
Get better.
We're not giving financial advice or anything like that. We put that out there, but on that?
No, I worked in markets for a long time, and bonds, and that's the interesting thing here. This last couple of years, when equities have done what they've done, typically you'd be bailed out by bonds rallying. But of course, both major asset classes have been hurt. So look, you can't be expecting stellar performance, but it'll be improved because I think the bond performance, at the very least, will produce its coupon, its running yield. I think the capital losses will be minimal. I don't think you're going to see a big increase in long-term interest rates from here. If we do, we're in real trouble. I don't think our superannuation will be our main concern at that stage. So yeah, I think they're going to improve, but I don't think we can be expecting significant returns for a few years yet. We've got to, it's the old story. We're in a market economy. Do you clean it out? Do you get rid of the problems and, have some troubles, but then, regenerate? Or do we just try and zombie our way through and patch everything up as best we can? Unfortunately, there's a real shift in the last 10 years to wanting to avoid those, somewhat traumatic cleanouts that need to periodically come, and as history tells us. I think we're going to be unable to avoid a clean out because the economy is fighting back. It's giving us inflation. And so I think we're going to have another tough year. And then I think the returns are going to get very good again. And that's me being the optimist, but it won't be as bad as the last few years.
I suppose if anyone else has got any questions to ask them now, but I'll ask you just one final one from me. And that is, I know you talked about China and you were concerned about what's happening with China at the moment. And I suppose the question I've got is, are commodities going to dig us out of a hole once again?
Mm-hmm. Yeah, yes and no. So the negative on commodities is that there's some downside risk to commodity prices. And clearly China's part of that story in the short term, the next year or two. But I think we shouldn't ever lose perspective that we don't sell iron ore and coal to China. We sell iron ore and coal to whoever's making steel in the world. Before China, it was Japan and Korea and Taiwan, who we still, I think, sell some coal and iron ore to. And beyond China, it will be Indonesia, Vietnam, and India, although India has a fair bit of its own iron ore, but you get what I'm saying. So yes, there'll be nasty adjustments from time to time, but our natural resource base is our natural resource base. I'd much prefer to have that than be in China's position. Longer term, we have not had an investment response to this commodity boom, which is probably our big mining companies and global mining companies being smart. They don't want to re-leverage to China on iron ore and coal. There's no doubt that the energy transition and all of that and the climate story is putting a lot of caution into these companies as well. But there's a lot of upside for investment in mining capacity in this country in the next 10 years in Queensland and New South Wales, and most importantly in WA. Now, I don't know what sectors it'll be in, but it's at such a low level. We're basically doing maintenance at the moment, that's an upside. It probably won't bear fruit in the next few years, but I think it's going to come through. And I think that's one of the fundamental reasons I'm very positive on this place, medium to long term. And one of the reasons I think we should take some pain now. I know that's not fashionable, but I think we're strong enough to do it, and it'll position us wonderfully for what is a challenging world environment, as the governor went through last night. So yeah, it's an interesting story, but it's our strength. It always has been.
Indeed, it is. Con, do you want to say any final words?
Yeah, Stephen, just wanted to say thanks to Warren for making time to present. Thanks to you guys from PCI for allowing us to present to your partners out there. And finally, if anyone has any further questions, please feel free to reach out to myself or to Warren, and we're happy to answer anything offline.
Yeah. Thanks, Con. Thank you, Warren, and thank you, Con, for actually taking the time and presenting today to our network. As Con said, look, I think Judo Bank's a very, very innovative bank, and I know that Con would welcome any inquiries that you might have. We'd like to thank you all for taking the time to actually attend our webinars during the year. This is the last one until February next year. We've had a lot of different sessions, a lot of different speakers, and we appreciate the time that you've actually taken to actually share some of your lunchtime with us. Guys, again, thank you very much, and everyone have a good rest of your day.
Fantastic. Thank you.
Thank you.